Number 1, please.
Adjusting entry to record the depreciation for the year.
Okay, but this is just for the year. This is not an error, man. Depreciation for the year only. You do this every year. So this is not covered by the standard. This is just normal accounting procedure, class. Diba you remember, you prepare your unadjusted trial balance, then you prepare your adjusting entries. Part of your adjusting entries is the adjusting entry for your depreciation. So this is not a correction of error. This is not a change in policy. This is just part of the regular accounting process. So not covered by the standard.
Number 2, a change of valuation of inventories from first in, first out to weighted average. Our answer is cap or change in accounting policy because referring to page 123 of the textbook, the standard states that one example of an accounting policy is the valuation of inventories from first in, first out to weighted average.
Okay, that's correct. Okay.
Adjusting entry of prepayments to reflect the correct balances of assets and expenses. Our answer is NC, or it is not covered by the past date.
Again, this is just part of the regular accounting process. Next.
A change in the measurement basis of property, plant, and equipment from cost model to revaluation model. So our answer here is CAP, or change in accounting policy.
Okay, that's
because
correct.
because it was stated in the book that measurement basis and subsequent measurement for PPE such as cost model, fair value model, and revaluation model are examples of accounting policies here.
Okay, that's correct. Next.
5. A change in the depreciation method from straight line method to sum of years digit method. So we answered what our group answered, sir, CAE, sir.
Okay, that's correct.
Because
I think we have a similar illustration earlier here. Let's proceed to number 6.
So number 6, the change of residual value of a certain PPE. Our answer for number 6 is CAE because it is a change of the value of property, plant, and equipment.
Okay, and of course, class, the residual value. I hope everyone is familiar with residual value, class. This is the expected or estimated value of the property at the end of its life. So basically, residual value is just an estimate. This is the amount that you expect the asset to be worth by the end of its useful life. So obviously an estimate.
Number 7, an increase in accumulated depreciation account due to omission of last year's depreciation. So our answer for number 7 is COP, or correction of prior period error, because based on the statement, the word here, omission, is a clear prior period error of last year's depreciation.
Okay, so that's correct. Very important, class. Do not limit your understanding of errors into wrong amounts. Omissions will also be a source of error. If there's something that needs to be recorded but was not recorded, was omitted from the records, then that is also an error. Do not forget that errors include omissions. Number 8.
Number 8, sir, overstatement of inventory due to the inclusion of consigned goods in the inventory count. So our group answered COP, sir, or correction of prior period errors here.
So again, this is not an omission, class, but you wrongly included an item that should not be included. Consigned goods should not be included, but you wrongly included it, so therefore there is still an error.
Number 9, changes in the fair value of a financial asset measured at fair value through profit or loss. Our answer for number 9 is CAE, sir.
Okay, so
Because
fair values are merely estimates, class. Last number.
Application of a standard to a newly occurring transactions. Our answer it is not covered by past 8.
Okay.
As mentioned earlier, sir, kay application of a new standard to a newly occurring transactions is an initial application of a standard.
Okay, and therefore it is not a change.